Hello, welcome to the Market Cover. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you, as always, for clicking. Give us a few minutes of your time, where we've got a couple of points from yesterday's investment allocation meeting. When I say yesterday, we film on Tuesdays. We have our weekly investment meeting, as we have for year after year, decade after decade, on Mondays, where we go over some of the most important topics that we kind of review, research, and analyze from the prior week. So here's two things that we thought that we'd share with you. We're going to talk about high yield debt and bankruptcies. I know it's a mouthful and may not sound like the most exciting, but I'll try to put it simply and analyze and unpack why there could be some importance and how we look at that on your behalf. And then we're going to look at asset size performance, and Andrew's going to update us on which size we want to favor right now. So let's go into high yield debt and bankruptcies. Just a little word. I think high yield, even though it's really a small corner and a small pool, asset wise, it's an important thing to pay attention to. Number one, because it's got a mix of both stock, because it's got risky nature to it, as well as fixed income, because they are bonds. So when I say high yield debt, just to bring us all on the same page, these are corporations who don't have the best credit rating. They are not your Apple or your Berkshire Hathaway. They are companies who have a relatively high probability of going bankrupt. And so in turn, they really don't get issued long-term debt. They're more like 4 and 5 year range, which is typical. That makes sense. If you're lending money to an enterprise that has some risk, 5 years seems like a long time. So think about this. If you were a homeowner and having to refinance your mortgage every 5 years. And that's why this group is important, because every 5 years, you've kind of got a rotating nature of debt going. And if they are caught at a time when interest rates are high and investors aren't willing to lend them, it has a chance to spill over and have broader implications. High levels of bankruptcies could produce higher levels of unemployment and kind of kickstart things in the wrong direction. So there's a lot going on in this chart. I'll just point you to a couple of key things. The first is that, is that red line. And that is measuring the amount of additional interest that these companies are paying or that the bond investors are receiving for these types of debts. So think of it in terms of how much you would get if you were investing in treasuries and then an additional risk spread. So in times of distress, the highest point on this chart, which was crazy, the great financial crisis in 2008, that was an outlier. But you can see there have been many other periods, the recession in 01 and 02 at the start of this chart. That red line goes up high at around 10%. That means that investor was getting an additional 10% above and beyond what were treasury bonds at the time. And this goes through cycles, up and down and up and down. And then the other line that I would point you to is just the smooth blue line. If you could find that on this chart, that is a rolling average of bankruptcy. So what we have at this point in time is the red line has gone down. That means that demand and investors are willing to take this risk of holding these companies that have a higher degree of bankruptcy. And they're willing to do so without a lot of additional income relative to periods in the past. In fact, it's at a pretty historic low. And that's interesting because bankruptcies have been ticking up. And again, that makes sense because we're at a period of higher interest rates. So as these companies have had their debts come due, if they were issued in 2020 or 2021, the rate was much lower. So we're at this higher level of interest rate. So we should see more bankruptcies and more challenge there. That doesn't mean any doom and gloom for the economy, but what it does mean is that investors, we don't see you getting paid for this type of debt. And so we prefer to take our investment risks elsewhere. This is the worst time to own these types of bonds when you're getting more and more of them to not make their payments. Meanwhile, you're getting paid less to take it. So that's how we think and analyze and make fixed income investment choices on your behalf. One of many, but an important one. So that's the bond side. Andrew, over to you and look at asset size.
All right, thank you, Adam. So a theme that's gone throughout this year and was throughout last year was that the market was most concerned and most interested in large cap, mega cap stocks. You've heard us numerous times talk about the FANG stocks or the Magnificent Seven. Those have been some of the largest stocks in the market. And that theme has continued to play out. One change as far as when we start looking at the performance of different asset classes or asset sizes is we're starting to see more, not just a relative weakness in smaller capitalized stocks, but an outright starting to see more of a decline. So the chart that I'm bringing this week is looking at the four major types of asset sizes. We have large cap, mid cap, small, all the way down to micro cap, the smallest companies that are publicly traded. And so we can look and evaluate the different trends and which ones are showing strength on an absolute basis, meaning is price going higher or lower? And is there any significance or anything that's differentiating one group from another that we need to be aware of? So when we look at large caps, that's your S&P 500, your 500 largest stocks. It's continuing to go from the bottom left to the top right. The trend is continuing to move higher. We saw the test of a recent breakout, but for the most part, large cap stocks are holding up really, really well as far as a collective. Then when we start moving further, getting smaller and smaller, we can see I put a blue arrow to show where our latest price is, that the price is starting to decline. We're not seeing the same type of uptrends, the same type of strength as we are in large caps. And so with that, we want to make sure that within our portfolios that we're positioned to capture that spread, that difference. So making sure that we do have a little bit more bias or focus on larger capitalized stocks. While we very much would like to be more diversified in the sense of owning a lot of different size companies or that different exposure, being diversified just for diversification's sake isn't always the best strategy, because sometimes we do have an opportunity to where being active and the active approach that we take can actually be a positive benefit to a portfolio when you do have markets moving in opposite directions like we see today. And so the market right now is punishing, so to speak, smaller micro cap, small cap stocks, and it's rewarding large cap stocks. And so we need to be aware of those dynamics and understand the exposures that we have in different portfolios to make sure the risks that we're taking are appropriate. It's not very common that we see this type of action. Traditionally, they all move for the most part in the same direction. One market may be stronger than the other, but they traditionally will trend together. So it's very interesting to start seeing this bifurcation of trend to where smaller stocks aren't necessarily not just keeping up, but they're actually declining while strength continues in the large cap market. Pretty interesting market environment that we're in right now.
Yeah, absolutely. And well put as always. Thank you. And thank you to all of you. As always, we give you a reminder, if we could be of service, give us a call, 800-928-4001, or scan the QR code and book it electronically. Thanks and have a great weekend.